much for joining us on a Sunday morning and taking out time to actually listen around what is happening in the Indian startup ecosystem. Today, we have a very exciting webinar, and I would like to introduce y'all to the guest for today. So, our guest today is Shuchi Pandya, principal at Fireside Ventures, the fund behind brands like Mamaearth, Boat, and the Sleep Company. But she herself has been an operator and she has founded Pipa Bella, built it for 8 years, sold it to Nykaa, and then scaled multiple brands inside Nykaa Fashion before crossing over to the investor side, which means she's exactly lived the journey most of us here are on: zero to one, raising, scaling, and exiting. Please welcome Shuchi Pandya.
Thanks, Ayush. Thanks a lot. Really happy to be here on a Sunday.
Thank you so much. We're really grateful to have you here, and the people in the audience are also really excited to learn today and have some insights around in how to actually build a consumer brand per se, right? Because you yourself have been an operator, build a consumer brand, scaled it, and now being as an investor, you see hundreds of founders pitching to you also personally over emails, over personal coffee conversations, meetings, etc. Right? So we're really excited for the conversations ahead. And if you allow, we can start with the questions right away.
Yep, that'll be great.
Yeah. So, Suji, my first question is that you built Piper Bella for 8 years, sold it to Nykaa, ran private label brands inside Nykaa, and now you sit on the other side of the table. When you meet a founder today, do you find yourself thinking like the investor, or does the founder in you still show up first?
I think once you're a founder, you're always a founder. So I don't think that that aspect, will ever go away. Of course, I do have a very nuanced, investor lens now that applies to all my interactions with founders, and I think that's what makes uh, my evaluation and my engagement with founders unique because I start off largely thinking of it as a founder to founder conversation.
Right.
But over time, I can, put on that investor lens and I can step into my investor shoes and step out of my investor shoes,
Right.
as and when required.
Got it. So, like, just out of curiosity, I would like to know that, sometimes your founder nuances also kick in while you sit as an investor, as you said, right? So, like, as you became an investor later and you were a founder before, does it happen that while you are in a meeting, you hit a deja vu point that this has happened to me on the other side of the table, and at the same time, the investor reacted this way, and now you realize that, okay, this was the reason why they, actually reacted in a certain way? Does that happen?
Um, yeah, I mean, so I think that yes, it does. I mean, I think it's when you're on a founder, when you often don't know what the investor's
Right.
thinking, and it's a big black box, honestly, this VC
Hmm.
fundraising and even trying to figure out what VCs are thinking, because it is true VCs are evaluating at all points of time, especially if
Correct.
you're pitching. So, having now been on the investor side of the table, it does.
Hmm.
There are moments where I think the founder journey, it just put a lot more perspective to my founder journey, right? There were things
Okay.
when I was a founder that I felt were, oh my God, like, how could this happen? And how could this, how could this founder say this investor say this to me? But then as an investor, now you
Mm.
realize why,
Right.
investors say certain things or why they,
Mm.
do certain things. So that perspective, really changed for me. It put a lot of
Mm.
things into, it started making a lot more sense.
Right. Got it. And like, does the founder bias also hit, like, as an investor when you're sitting and a founder has explained you certain thing and you know that this is something which is wrong, but you understand from the point he's speaking for, and
Yeah.
as an investor you might have not invested, but due to you being on the other side, you might have just given it a shot. Does that happen?
So, I think the founder bias is, I wouldn't even call it a bias because it's not a bad thing, right?
Right.
I think the
Mm.
fact that I've lived the founder journey makes it easier I think for some of my founders, at least who are on my portfolio, to ask me certain questions which, maybe they wouldn't be able to ask, a traditional VC.
Hmm.
And hence, when I sense that, I typically take off my investor hat and have a very honest conversation with founders, saying, "Look, this is where,
Hmm.
this is what I think you should do. This is, my perspective, having seen both sides."
Hmm.
And I think that is appreciated because, again, founders don't get to necessarily hear that side of the story, side of the
Hmm.
investing story, but also they don't necessarily have that same rapport with a lot of the VCs, right? Because
Makes sense.
for them, they
Correct.
think the VCs are, some different breed of people, and they
Yeah.
think differently, and that's not always
Correct.
true. I mean, I think Fireside, I mean, of course, I'm a founder turned
Hmm.
investor, but to be honest, at Fireside, a lot of us are operators.
Right.
In fact, many of us come from ex operating backgrounds, so we
Right.
do come with that perspective of having lived that journey as well.
Right. That's very interesting. But as you said that, many of the people who are at Fireside as investors, right, they've actually been operators themselves. If I'm not wrong, before being like on the investor side at Fireside Ventures, Fireside had also invested in your startup, right?
Yes, yes.
But so what was that like? Like, what
Yeah.
was like, how did, that happen? Like, because you had scaled your startup to a certain level, which was bootstrapped, and then Fireside came in on the later
Yeah.
stage, right? So how
Yeah,
was
so
that like?
Fireside was a new fund at the time. I mean, it was
Yeah.
that time, this was 2017 when Fireside, when I even started the conversation with Kaval, I was introduced to him through a very close friend of mine. And, I think Kaval and uh,
Mm.
I must have messaged Kaval many, many times, and, met him many, many times before he finally agreed to
Right.
invest in me, which I'm so grateful for because I think for me, it started the journey of Fireside. Fireside was a very new fund at the time. There were barely any
Right.
consumer focused funds. Most funds were tech funds that were, dabbling in D2C and consumers. So
Right.
Kaval's thesis of how the
Mm.
next 20 years of India were going to be defined by iconic brands was something that really resonated with me. So in my head, I was, very certain I needed to meet this man and, convince him to invest in my
Correct.
startup.
Yeah.
So I think that was a very early journey for Fireside. It was out of Fund One. I may have been
Mm.
investment three or four in in that fund, and there were just three, four people in the team at that point of time. Today we're a team of almost 35 people, and it's a much larger team. But I think the philosophy remains the same. We
Right.
still deeply believe in India's future being defined by these iconic brands and the fact that we want to back and we want to be part of that journey. We've had so many learnings in the last 9 years
Mm.
that we've been in existence. So many
Right.
brands that have succeeded, and that have some of them have gone public, some of them are going public, some of them have
Correct.
had extremely successful exits.
Yeah.
And I think there have been learnings across all of them, not just in terms of what kind of investments we want to do, but also what kind of business models work, what kind of operating models we need to implement within these companies to make them work.
Right.
So we've been able
Right.
to build playbooks and operating models based on all of these learnings of the last 9 years, which puts us
Correct.
now, and when we're investing out of Fund Four, in
Mm.
a stronger position. While we continue learning and the consumer landscape continues to evolve, we're in a stronger position today to invest in the next set of brands.
Right, right. So see, as you mentioned, the playbooks, right? And like the major portfolio companies at Fireside Ventures, right? Are or used to be D2C brands, right? For example, a boat started with Amazon, right? Mamaearth
Yeah.
also accordingly started as a D2C brand. Traya is still a D2C brand, right? So one thing which I have noticed, because like in the ecosystem right now, is that the unit economics of D2C brand is weakening on day-to-day basis. The reason is that the major distribution centers like Meta and Google are not giving certainly good ROAS, which used to be, 3, 4, 5 years ago, it would be 4x, 5x accordingly. And at that
Mhm.
time, the brand that scaled like unanimously, for
Yeah.
example, now boat has also, scale the channels. They've done entire manufacturing in India, not just assembling in India, but they end-to-end manufacture in India right now. Mamaearth has opened stores in major metro cities, right? So, what is your thought, or on D2C brands still starting with Meta, where there is no money left, or they'll be incurring losses for the longest amount of time? Because I myself personally know some D2C brands who had started like 7 8 years ago. They scaled to 2 crores a month, did 25 26 crores. Still they are stuck at the same number 2 3 years. And at that time when they were doing 20 30% gross, right now they are like even struggling to break even, even
Yeah.
after reducing the team size, etc. So what are your thoughts over that? Like how as a D2C brand you can not just survive but thrive in today's time?
Yeah, yeah. No, great question. So I think the answer lies in many different, things. So firstly,
Yeah.
D2C works very well for certain sectors. And certain sectors, there are other, better channels that, we typically recommend, right? But let's assume, for example, that a brand is starting with D2C.
Okay.
D2C is a great channel for gaining and building PMF, right? Product market fit, for the simple reason that you have direct access to the consumer. So unlike an Amazon or a quick commerce where you don't get direct access to the consumer,
Right.
here you have the direct access to the consumer. You get feedback. You can actually pick up the phone and your early journey, speak to consumers and get a sense of what they like, what they don't like about the product. So
Right.
for an early journey till the business is 30, maybe 25, 30 crores in revenue, D2C is
Yeah.
a great channel. Yes, it is bleeding in terms of unit economics. And
Yeah.
sometimes that can be balanced with, multi-channel approach. So you also have, some products um, in um, in Amazon, some products in quick commerce, etc. But D2C being that channel where you can really get access to the consumer. Once you have
Right.
got PMF, I think, which is at that 25, 30 crore stage, a lot starts making sense in the journey for the founder as well, right? One is you start thinking about new levers of growth, which
Okay.
could come in the form of new products, new categories. It could come in the form of new channels, because now suddenly you're saying, okay, I've attained one level of PMF. Now I need to improve that product and start scaling, right? And that's
Right.
usually upon a time when deepening partnerships with marketplaces becomes a lot more sense. You continue your engagement on D2C, but unit economics can be improved at that stage by one, it comes from obviously better supply chain economics as you're scaling, but two, also some of these marketplaces you can leverage the scale and the reach of their consumer base, once you've hit a certain point. Also, repeats start
Mm.
kicking in, right? So what happens is that
Right.
because you've gotten to a certain stage, consumers have gotten used to your products. There's a loyalty that's starting to build in. The repeats start kicking in, which also in turn help your unit economics.
Makes
So then
sense.
there's a journey from about 30 crores to 100 crores,
Mm.
which, for example, quick commerce, Amazon, some of these marketplaces make a lot of sense.
Right.
And then, there is a question at about 100 crore stage, which is this maybe the second or third milestone for the founder, where
Mm.
it now the question is, okay, what next? And at that
Right.
stage, it's really about thinking of offline, again, new
Mm.
categories. You're thinking about how to expand the brand a little bit better. Are there some
Right.
nuances we need to think about on the brand? Are there new customers we need to reach out to? So there's another milestone at 100 crores that gets reached, and they have to founders have to answer those questions. At each one of these milestones, of course, unit economics play a very critical role. But as
Right.
you're scaling, our hope is that if you keep fine tuning the channel mix and
Mm.
not only be very dependent on D2C, that
Right.
does bring healthy economics into the business, and it does bring some level of streamlining to the business as well.
Got it. So what I understood from what you just said is that for a consumer brand, D2C can be a way of PMF. Once you've achieved PMF, you have to approach a mixed channel way to actually distribute a product really well so that the unit economics starts making sense. And what the
Right.
good sign of attaining a good PMF is once you start having repeats. A good significant amount of your orders are repeats. That is when you know that you have hit a PMF, and then you can start scaling towards different other channels, right?
Yep. Exactly.
Got it. Got it.
Repeats, reviews, good ratings,
Mm.
referrals, low returns. These are all good signs at that 25, 30 crore mark, which usually signal PMF.
Mm. Right. So, like, one more question which usually confuses founders who've recently started as a D2C brand. So they are not investing as much on the, D2C side. For example, nowadays, correct me if I'm wrong, but many people who just want to start in the excitement of starting up usually start with D2C because it's very accessible in terms of distribution. You can
Correct.
just open a Facebook account, quickly put a creative, create it an AI, and then start running ads, right? So my question is that usually with D2C, the mathematics is really simple. But as soon as, let's say, for example, Mamaearth started opening offline stores, right? Now Mamaearth is huge. If I go to any other brand also who's starting opening offline stores, then when you are just selling your own products, how does the maths work there, right? Because there's so much cost involved across the store in terms of fixed cost, variable cost, and
Yeah.
the manpower and so much other things included, which is very
Yeah.
different from a D2C maths, right?
Yeah. Very
How does that
different.
work? Like for
So there
example,
are
for
there are
anyone.
different
Yeah.
offline formats, right? There is
Mm.
obviously in you go and, like, for
Yeah.
example, general trade or modern
Mm.
trade, where you go and you're one amongst 50,000 different brands. The
Correct.
general trade would be your um,
Mm.
local kirana stores, etc. Usually general trade, or for some other categories, for example, in consumer appliances, it could be
Right.
somewhat of a, maybe a individual proprietor who owns a shop and has multiple brands. Um,
Right.
Modern trade is usually large retail chains, the likes of, say, Vijay Sales, Reliance Retail, Croma. Those are modern trade. Then there's
Right.
EBOs, which is exclusive brand outlets, which usually is I own the store, I run it,
Mm.
I run it, and it's my
Mm.
own store, so it's only my products will exist in that shop.
Right.
So depending on the category, depending on the product, and depending on the
Mm.
width that a brand actually has, they
Mm.
will decide which of these formats they want to take up. There's also, for example, kiosks, right, where you can be a
Mm.
small, like 50 square foot kiosk in a mall or an airport,
Mm.
etc. That's another model, and some businesses are built entirely on that as well, right?
Right.
So it depends very much on the width. Like there are some
Mm.
businesses where there is very low width, and does it
Mm.
make sense to set up your own store and set up the capex for the store? You know, get the walk-ins yourself,
Mm.
be responsible for bringing in walk-ins. That's, again, an expensive affair. So that's a question that brands need to answer. And there are some formats which actually lend themselves very well to to exclusive brand outlets. For example, fashion, right?
Right.
Fashion is a category where it actually makes sense to have exclusive brand outlets versus any other. In fact, it's we say that for many fashion brands, offline is better than online, right? Being going offline first sometimes makes more sense because you
Correct.
have the ability to showcase all your product, etc. And
Mm.
and of course, I mean, it's very dependent on
Mm.
the location, the city,
Mm.
and the kind of expansion you're planning to do. Certain metros are very expensive, whether you're doing high
Right.
street, where you have to bring in the walk-ins, or whether you're doing malls where the walk-ins are brought in by the mall.
Mm.
Again,
Right.
the unit economics depend on that. Your
Correct.
and But usually, see, offline is something that comes in slightly later in the journey. Again,
Mm.
you need to have built some brand loyalty. Use online
Right.
as a way to experiment, to figure out what is working with the consumers. Your reach is also far wider. You're
Mm.
able to figure out which cities, which geographies are adopting your product better through online, and
Yeah.
then slowly move to offline once you have a lot more data points on what is working, which cities are working, which geographies are working. Experiment a little bit on all these different formats I
Correct.
talked about, and then some sort of playbook starts emerging.
Makes sense. Correct. Again, coming back to your point of first attend PMF and then start scaling offline is what,
Yes.
right? Makes sense. So, Suchi, like before going to the next question, guys in the audience, please do react to the poll. We are coming up with the first poll. This is all regarding the consumer brand, so please do interact with that. Yeah, this brings me to my next question. That I had, so like I believe, so I get confused between two approaches when you want to start a business. So one I term it as that resource first business, and one is that idea first business. What I see with your journey when I was reading about you, or let's even talk about Aman Gupta from boat, right? That Aman Gupta used to work at a JBL at a very good position. He left JBL and then he started boat, right? Just like summing it up in short, right? That means that he had a good insight into the industry of how the entire variable market works, and then he
Hmm.
started it with the same, right? For
Yeah.
example, you, if I'm not wrong, you had a family business into jewelry, which
Correct.
then had got you some insights over how the jewelry market works, or what a
Yep.
consumer wants, how does the unit economics work. You might have some support over the supply chain too, right? Because you were in the market with so long, with the family business itself. Now that
Yep.
I can term it as a resource first business. Now the
Sure.
idea first business is that I go on Google, or I go on the drawing board, I see that what kind of industry matrix are running off, and I pick the highest potential industry, I check my passion into it, and then I try out a vertical which might enable me in the start, and might get me into a phase where I start breaking even. What do you think, what is a healthier approach?
There's no right answer, Ayush. It's very, see, there are, India is a very um, brand starved nation. There is latent demand which is sitting across so many different categories. And if
Hmm.
you are sitting with some sort of supply chain advantage, then you are in a great position to, bring about, to start a brand and cater to that demand, right? Because
Right.
generally speaking, I would say latent demand is there. Supply
Hmm.
constraints are where the issue
Hmm.
lies, right? Good quality
Yeah.
manufacturers, having a
Right.
lot of good suppliers who can create a product for that latent demand. And of course,
Right.
good founders who can take that good supplier and, figure out how to cater to that latent demand. So I don't think there's any one right formula. See, I
Hmm.
think the good brands that we have seen emerge have usually come out of two things. One is a very strong consumer insight that, we that the founders have spent time with the consumers, asked the right questions, figure out where is the gap really, right?
Right.
And started small. None of them really started
Hmm.
with 30, 40 products. To give you an example, I mean, Varun and Ghazal started with a mosquito repellent and a baby, like
Right.
a baby like colic roll on, right?
Correct.
So it was just two products which they built actually from a personal problem that they were facing in with their own child. So one is, of course, that you essentially build something which where you have a strong consumer insight. The second one is where
Hmm.
you're facing a problem yourself, like you have lived and uh,
Makes sense.
experienced a certain problem or a gap, and you feel that you need to solve this ASAP. I'll give you another example of a brand called Cumin Co. They didn't really come from any, cookware background. Both the founders, husband wife duo, were one day cooking for their 4-year-old child and saw that in the cookware there was some black specks that were emerging in the food.
Yeah.
And that's when they realized that there was leaching that was happening from the cookware. And they just found that completely
Right.
unacceptable. Both of them, spent some time researching and said, this is a genuine problem, quit their jobs
Hmm.
and started Cumin Co. So a lot of brands just come from personal problems as well that they're trying to solve. Of
Right.
course, you need to ask yourself the question, how large is the problem? And is this something that I really want to solve? Underneath is another great example where Kusha
Yeah.
and Vimar started it. Kusha was looking for shapewear in India that suited Indian climate, that worked for Indian women body types, which are again very unique. And she solved for it,
Right.
right? She found and met Vimarsh. They didn't know each other, but they found and met each other, and sort of bonded on that
Right.
problem, and decided to solve for it. So there is no right answer. Is what I'm basically,
Correct.
yeah.
Right. So, like, I partially agree with you, Suchi, but in your examples itself, I found one or two more examples of how resource first businesses work, right? For example, with Kusha and Vimarsh itself, right? Kusha had the distribution, right? She had a personal brand which resonated well with what Underneath wanted to sell, and
Yeah,
Vimarsh had the business side to it, right? So, when
yeah,
they both got together to build something like this, right? Obviously,
yeah,
that Kusha was someone who was looking for chefware which suits Indian bodies, Indian weather, etc. But
yeah,
resource is what it at the end worked, right? For example, if Kusha did not have a personal brand, she was a person who was just looking for the idea, then I don't think Underneath would have worked out the way it worked out today, right? Because for them, the starting point, the CAC was zero to a
yeah.
level where the brand awareness came from Kusha herself. And then they started building, right?
In category creation, yes. I mean, so for example,
Yes.
when you have to build a category from scratch, you're right. I mean,
Right.
I think it makes sense to have someone with a distribution moat who can really help you scale and bring the product to many different people. But I'll be honest, right? I mean, in
Mm.
Mamaearth's case, it's not that they
Mm.
had any supply chain moat.
Yeah.
They didn't have any
Right.
suppliers. They
Right.
didn't know. Yes, sure. I mean, Varun had spent some time at Coca-Cola, so he knew and understood FMCG, but it's not that he understood personal care as such. And so he
Totally
built
agree.
that
Right.
from scratch, right? It
Yeah.
was the knowledge that you build and the research that you do. So all I'm saying is that yes, I agree. Of course, having a supply chain advantage, having a distribution advantage is great. If
Mm.
you have that, one should leverage it because, like I
Right.
said, India is sitting on a lot of latent demand. If you have
Mm.
that supplier advantage or distribution advantage, I mean, there's nothing like it. But we've
Yeah.
seen a lot of great brands. I mean, Yoga Bar is another great example.
Correct.
So Hasni was living abroad and moved back because she realized there's, abroad everyone
Yeah.
eats
Excellent
yoga,
brand. Yeah.
everyone eats, snack bars on the go,
Correct.
and there was no such concept in India that existed. Again, she worked and she figured out where she could get government grants, subsidies, met a whole host of factories and suppliers where she
Mm.
could build
Yeah.
and create prototypes for her product. So yeah, and whereas of course there are other examples where the opposite exists, and that's also been successful.
Right. Makes sense. No, no, I totally agree on that point. So my next question is like, what is that one question which you expect when you meet a founder for a meeting that they will ask you, but they usually don't, and that is one of the points where it is a kind of a red flag for you that this is something the founder did not ask. Do you have something of those questions in your mind?
It's not really a red flag per se, but I think it's always a good question to ask of
Mm.
VC because I think one of the big learnings I've had having now been on the investor side is that, while founders assume that when VCs are talking
Mm.
to a founder, that the founder is that the investor has the ability to invest and the corpus to invest. There are
Mm.
many reasons why investors speak to founders, right? Which may not
Correct.
necessarily lead to an investment. And I'll give you an example.
Correct.
Um, so one, a lot of VCs might be just talking to you for relationship building, right? They may
Mm.
not actually
Right.
be, ready to deploy funds at that point of time. Two,
Right.
the stage at which a VC is at in terms of their
Mm.
fund life also matters,
Mm.
uh, because
Mm.
because if you're about maybe 3 to 4 years into your fund life, it's towards the end of your fund life. Usually, you don't deploy
Mm.
as much, or you're saving more for follow-on rounds, and so there
Right.
is genuinely like most of the deployment in a fund happens in the early stage of a fund,
Right.
right?
Mm.
The third is you could be past a fund's phase of
Mm.
investing as well, right? Like, for example, or it could be too
Correct.
early. Like, really
Mm.
understanding what stage at which that investor invests typically,
Mm.
what IR,
Mm.
what investment model they have, where
Right.
what check size would be their sweet spot. I think understanding that
Mm.
also makes sense. So sometimes
Mm.
PCs may say yes, no to you for a host, or may say no to you for a host of reasons, but it's not
Right.
always linked to your
Your
business
business. Yeah.
and you as a founder. So sometimes
Mm.
having that perspective helps, right? Because then you're able
Makes sense.
to, and a lot of founders don't know that, right? They just think
Mm.
that they take it personally, saying, "Oh, they didn't like my business," and VCs may not even tell you that reason, but genuinely there are these maybe aspects of the VC industry which can, I would say, constrain or maybe, hold back a VC from putting in money.
Right.
So it's
No,
important to
correct. I
ask those
mean,
questions
yeah.
sometimes to VCs, like, what stage of investing are you at?
Right.
How much, what stage in your fund life are you? What is your typical stage in which you put in money? Am I too early? Am I too late? Those are the kind of questions it's always good to ask a VC.
Yeah. I mean, I think it's really helpful too because sometimes you might take a no for a very wrong insight that your business has some problem. It might, but I mean, sometimes these are the points where actually
Yeah,
the no was the reason for. Right. Yeah.
yeah.
It actually totally makes sense. So my next question, Suchi, is that I was talking to an investor like 2 months ago, and my question to them was that what is one of the red flags in general? I asked that you see in a founder, right? So he said that when a founder comes to me and he pitches in a way where he wants to give me an exit, that for example, I'm building this and this is the way you can put 100 rupees into me, and after 3 years I will give you 500, right?
Hmm.
He basically wanted to say that I think that is a red flag because I would want to invest in the vision where the core motive of the person who is pitching to me right now is not exiting. It's more
Hmm.
about how do I want to build this big, not
Hmm.
exiting is obviously part of the journey where you might get an exit and you might end up taking it a very good exit, or whatever the situation is. So but that should not be the core reason behind you building, and at least
Hmm.
not pitching that to an investor where you are like, okay, I mean, you will get rich quick, something kind of that, right? I wanted
Hmm.
to ask you that does that hold true for you? And if not, then what for you is that angle where you are like, no, this is not right?
You mean in terms of red flag? I mean, so
Yeah.
I think, yeah, I mean, I think certainly talking about exits in the first
Mm.
meeting,
Mm.
may not necessarily make sense because I think
Yeah.
VCs are also not thinking about exits in the first meeting. They're just evaluating
Correct.
the business opportunity. Exits does
Correct.
become a point of evaluation as, the investment team goes deeper into
Yeah.
diligence of the business,
Mm.
but it's
Yeah.
definitely not the first point. I would
Right.
say that an important aspect of I would say a red flag is if a founder is, and this is controversial, and I'll just put it out
Mm.
there,
Mm.
because I think that, a lot of
Mm.
founders don't realize that the VC and founder
Mm.
relationship, at least the ideal one, is a long-term one, right?
Correct.
So if a founder is optimizing a lot for
Mm.
short-term valuation, right, and
Mm.
gets really, really held on short-term valuation that, oh, I must hit a certain number and, I will not go beyond that, and gets really stuck on it.
Mm. Mm.
Um, of course, there's some wiggle room here and there, and there is
Mm.
movement. There is obviously space for
Mm.
negotiation, but I would encourage founders to think a little bit bigger than that because it's a
Yeah.
long-term partnership, right? You're looking
Mm.
at raising multiple rounds of funding with investors, and you're going to bring on many, many investors, hopefully, larger, growth investors, private equity investors. At some stage,
Right.
if you go public, you'll have public investors. And I would say that the kind of investor matters more than just get someone who's going to give you, like, say, a 5-10% higher valuation.
Makes
So
sense.
those, I would say, if those become a little bit of a red flag, that, if a founder comes to us and says, oh, but so and so VC is giving us a higher valuation,
Yeah.
um, and you should match that, etc. We generally don't like to play that game because for us,
Right.
it's more important that we're able to display our value to the founder and be a sounding board and a good solid partner to the founder in both good and bad times, not just when the
Makes
business is on
sense.
a high.
Makes sense. So, should I take the takeaway from here for like for anyone who's watching this and is an early stage founder would be that For example, you should not just look at the funds and the valuation which a VC is willing to deploy, but you should also look at the resources and the access they will enable for you in long term, which might help you scale better. And also it will help you in long term in terms of advices also. For example, if I'm a early stage founder, I'm building a consumer brand, I get invested by Fireside Ventures. I might also get access to some of the biggest consumer brand founders for, even 5-10 minutes if I want advice to them through Fireside Ventures itself and the principles there, right?
Yeah, I mean, I think it's
Just an
the
example.
value
Just an
add. Yeah, yeah,
example.
I think
Yeah.
it's the value add
Correct.
that a VC can bring in terms of connects, in terms
Right.
of the sort of learnings that you may get across the board.
Right.
Those to me are more important and valuable. I think that can actually increase your value much more over time than just
Right.
optimizing for valuation today.
100% makes sense. So, Suchi, before opening for questions, I have one last question for you. As you've been an operator, you've been an investor. If given a chance again, hypothetically, would you choose to be an operator or you would continue to be an investor itself?
No, I think that the investor journey has
Yeah.
given me so many
Yeah.
different, areas and sectors to learn
Yeah.
from, and
Mhm.
which I think operating is of course amazing because you do end
Yeah.
up deep diving into one specific business and trying to solve a problem. And
Right.
I in my mind, at least in my journey, never say
Mhm.
never because you can always go back to operating. I've
Yeah.
lived that journey, so it is a place which I feel comfortable in. But
Right.
I don't think I'm done with investing just yet. I think there's a lot to learn, a lot of different spaces where I
Right.
want to dabble in, and a lot more businesses and founders that I want to work with and make an impact on that level. So
Got it, got it. That perfectly makes sense. So thank you so much for answering all the questions, first of all, so patiently, Suchi.
yeah, no,
So
no, my
before,
pleasure.
yeah, thank you so much. So before we start with the audience questions, there's another poll coming up, guys. So please do react to it. This is again regarding the consumer brands itself, right? Yeah, yeah. So I'll just take some questions from the Q&A we've gotten. Right. So Pratham has a question, which is that when should a startup raise its first funding round?
There's no right timing. It really depends on when. I would say that when you feel that you've hit a certain milestone where just
Mhm.
money alone will not get you to the next level, where you
Mhm.
think you need to open up more access to, at least from Fireside, I would say, when you need more
Mhm.
access to distribution, when you need better access to certain learnings from other companies, that's, a good time for you to raise funding, right? Because for some founders, that is from day zero. For some
Mhm.
founders, that is from, say, day, maybe 120, like 3 months into the business, right? For some, it could be, once they've hit PMF.
Correct.
But it's really about just capital alone is not going to be enough. You really need more
Mhm.
to scale and to get you to the next level.
Makes sense. So the next question is from Kiran, which is which matrix or signals would you want to see from startup before considering an investment?
So I invest typically, thanks Kiran for the question. I think I invest typically in the venture stage, and that venture stage for
Yeah.
me is usually a post P, once some sort of PMF has been hit.
Mhm.
So I would look out for signals such as, obviously some products that
Mhm.
are in the market that are doing well, where you're able to see,
Yeah.
the initial repeats kicking in, where you're able to
Mhm.
see some sort of reviews,
Mhm.
positive reviews coming in for the brand,
Right.
where you've got a couple of channels working for you.
Yeah.
So it's more of, either you're on D2C or you're on Amazon, but you seem
Yeah.
to be getting a good feedback loop in place. Where
Yeah.
through those channels you're getting customer reviews. With those customer reviews, you're able to make your products even better and create, better versions of your product. So that has been put in place. There
Yeah.
are you've as got some basic team in place. It doesn't have to be all your L1s, but some a few couple of people that are running point. It's not just the founders who are doing everything. I think that's definitely not a good place. You want a few folks doing multiple things. Um, I think that's about it. Yeah.
Yeah, yeah. So thanks, Kiran, for the question. So the next question is, pretty interesting. This is from Shreya. So she asked that Mamaearth went seed to IPO in about 6 years, and now every consumer founder gets asked why they are not growing that fast. Is that pace repeatable, or was it a one-off window that founders are being unfairly measured against?
Interesting question. See, I think that, of course, as you scale over time, uh, you have to unlock new avenues for growth.
Hmm.
And today, I would say it is easier to get to a scale than when it was for Mamaearth. Mamaearth maybe started in 2016. It took
Hmm.
them maybe 3 years to get to 100 crore scale because at that point of time, Amazon was new in India. There was no quick commerce.
Yeah,
Like I said, there was no ecosystem around D2C and e-commerce that had been built. Today,
yeah,
businesses are getting to 100 crores within 12 months of launching. So it is, I would say, easier to get to scale. I do think that the fundamentals of getting from 100 to 500 crores, which is the harder journey for any business, and of course 500 and plus is even harder, and that's a whole different, milestone. It's like you're climbing different peaks, right? In terms of a range of mountains, and every peak is higher than the last, and every peak is harder than the last, right? So you have to figure out. Uh, I would say the right kind of investors, the right kind of strategy, the right product mix, channel mix. Are there new brands? For example, Mamaearth acquired, Honasa acquired a whole range of brands, continue to acquire a whole range of brands. They've built great unit economics and strengthened the business that has given them enough free cash flow to actually acquire brands. So that's a great place for them to be, where value creation can come not only from existing brands, but a whole host of new brands that they either build or buy. And so it comes down to some of those things that at that 100 crore mark, how are you thinking of unlocking growth? And it's a very, I would say, relevant question that all founders get asked at that 100 crore milestone.
makes sense. Correct. So, the next question comes from Ria. She asked that you ran brand P&Ls at Nykaa, so you've seen the retail math from inside. What's the one number in a consumer brand's P&L that founders ignore and investors look at first?
CM2. Mm. So I think
Yeah.
like CM2 is essentially a metric where I would say gross margin and CM2, but
Mhm.
CM2 is essentially your contribution after having acquired a user. So it's
Yeah.
post your performance marketing spend, post your meta spends, etc. And the reason it's important is because an investor wants to know whether you're still making money after having acquired a user. And it's an
Correct.
important metric because if acquiring users is making you lose money,
Right.
then there is a genuine, I would say, fundamental flaw in the business model, right? So you have to
Right.
then tweak the business such that acquiring and having customers in your business is profitable and makes sense for the business to run.
Right.
So if you're losing money after having acquired a customer, you need to really rethink what channel mix is going to make sense. Do I need to focus on products with higher gross margins, such that the business is sustainable over time? Initially, it's fine, right? In the first 1 or 2 quarters of the business, even 1 or 2 years of the business, CM2 negative, we don't encourage it. But of course, if it's there, it's fine. But it's really about building that long-term sustainability. CM2 becomes an important metric.
Yeah, makes sense. Hope Shreya, your question was answered. Yeah, thank you so much for the question. The next question is from Dharini. What about Indian ethnic wear? Is offline better or online to start with, and within online, D2C or marketplace?
Tharni, I think that Indian ethnic wear uh, is a tricky one because it's usually a long tail of product, and I would suggest starting online makes a little bit more sense with long tail. It gives you the ability to test out what's working, what's not working. And I would say quickly pivoting to offline because it's a very, trial led, touch and feel, high engagement category for most women, especially if it's high price point ethnic wear, the likes of Upernya's pop-up shop, etc. Usually, offline stores start contributing to a higher percentage of revenue over time. I'll give you an example of Mamaearth. Today, almost 85% of their business comes from offline. And same with a business like Purnya's pop-up shop, or even you think about a Biba or any of these. Like I think over time, the offline play becomes really critical. So start online, just experiment, figure out what works, and then quickly pivot into offline is what we would say.
Yeah, makes sense. But like, I have a follow-up question. So when you say that 85% of Manyabar's revenue comes from offline, but like, are the margins more healthier in online, or is the offline one only the good margin business also?
In Manyavar's case, the offline business is generating great store EBITDA, right? It's
Wow.
generating like almost a 30% store EBITDA, which comes straight to the bottom line in this
Yeah,
case because of
right.
course they've built a brand already. But generally speaking, if you have decent gross margins, your offline stores should do well, especially in ethnic wear.
Mm. Right, makes sense. So, Akshay Kumar has a very like interesting question. He says that I'm working in energy sector. We already have MVP and going for pilot stage development. We have 15 months of runway left. How much runway is healthy before raising?
See, you don't in this market, and markets keep evolving.
Yeah.
Generally, I would say 15 months, you're in a good space, nothing to start panicking. However, you never know how environment will change suddenly,
Mm.
right? We're in an uncertain climate right now with respect to geopolitical risks, etc. And we don't know how much, horsepower will remain for VCs to
Mm.
invest. So I would start, if you're with 15 months of runway, I would say start having conversations with VCs, start liaising with them, start building rapport, start building relationships. Maybe when you're at that, 10, 12, or maybe 12-month mark is when I would, go to market and, formally start pitching. Keep about, a good, because, and also closing a deal and closing a fundraise can take anywhere from 4 to 6 months, usually,
Yeah.
right? So you don't want to be sitting on 8 months of runway, and by the time the fundraise actually closes, you are down to, just a month of cash in bank. That's also not a great place to be. So start building relationships, start engaging, and maybe closer to about a year away is when I would go and hit the market and officially start fundraising.
Yeah, fair enough. So, one last question, Shuchi. This is from an anonymous attendee. So, he asked that if you were starting Piper Bella today in 2026 with everything you know from the investor's chair, what would you do differently from day one?
I would, for one, I think when I started, it was very early for D2C and for jewelry. Today, jewelry is one of the hottest sectors uh, in
Yeah,
uh, in the D2C ecosystem. So I would say
correct.
I was probably a little too early in my journey. I would have certainly built a strong team from day one. That
Mhm.
would have been on the top of my list. I would have
Mhm.
entered offline first, right? Or entered offline
Okay.
earlier. Kept
Mhm.
online as part of the journey, but maybe started offline stores within a few months of going live.
Right.
I also would have brought tech in to manage inventory and to manage, and to figure out what is working, what is not working in terms of my inventory and my product mix.
Right.
And I would say that there is a merit in having, celebrities, having a trusted face to the brand, which could have, which I could have leveraged and I would leverage if I were to start again today. So I think all
Right.
of these things, today jewelry is probably one of the fastest growing sectors in D2C, and we've seen some really good brands come out of it with the likes of Ajiva, Palmonas. We've got Okera on our
Correct.
business as well, and all of them have, I would say, met a lot of these requirements, right? Been offline
Yeah.
first,
Yeah.
got a celebrity on board, brought in tech, hired a very
Yeah.
strong team from day one.
Right. Right. No, that totally makes sense. So this brings us to the end of all the questions. We had so many questions, but majority of them we already answered while we had the conversation around. And I would like to really thank you for being so patient with all the answers and being straight out, upfront, and very clear about all your answers. This was really helpful for me also. Personally, also, I learned a lot from the conversation as you
Thank you
had very
so
good
much.
insights. Thank you
No,
so
I'm
much
so
for your time,
grateful
Suchi.
yeah, I'm so grateful to be here, and thank you again for a really engaging Sunday morning.
Thank you so much, Suchi. Thank you. And we'd hope you to host sometime again. And we'd really
Would
be
love that.
glad to have you again sometime. Thank you
Yeah,
so much.
would love that. Yeah. Thank you so much. Take care.
Thank you. Bye bye. Take care. So, guys, hope you all had a very good Sunday mornings. Hope you could learn from all Suchi's experiences as an investor, as an operator. And I would like to give a shout out to the Indian Dream. You can please go visit our website. We have got a lot of content around. We are a magazine company. We sell really insightful magazines. What you could learn in the 45 minutes with a conversation with Suchi. We have such investors articles in the magazine which are basically 3,000 words, like three hours of podcast content, like very abstract, very technical for you, all the questions you would want to ask to an investor into an article. And we have such 8 to 10 articles in one magazine. It's an HBR kind of magazine. You'd really love the content and it will really help you build into your entrepreneurial journey. Go check us out today, the indiandream.club. That's the website. And buy the magazines if you like it. That's not a problem. And we'd see you in the next episode of the Investimonial. So thank you so much for all your time. Have a good weekend. Bye bye. Thank you so much.